Hello, Namaskar viewers. I am Sanjeev Pandya and it is so good to be back with you with your favorite show as we are now into the year 2025. That means it's time to talk about the taxes. I know that you don't want to hear about taxes, but taxes are taxes. We all have to pay the taxes, and this is the show that Tax Talk brings you all the latest that you really need to know for your personal and corporate income taxes. You've been very supportive and you've been watching the show since last 3 seasons. So thank you so very much, and we are now here for season 4 episode number 1, the Tax Talk with Ajay, the show brought to you by CPA Services, a full-fledged professional accounting firm located in the state of New Jersey, multiple locations, but they can help you wherever you are in the United States of America. Their knowledgeable professional staff, CPAs on hand, can assist you with any tax matter. For an appointment, you can give them a call at 908-380-6876. And if you are one of the first ones who are watching this show on your favorite TV channel, ITV Gold, my suggestion is to visit their website, cpasservices.com. With that note, let's begin the first episode of this season 4. And I'd like to welcome the CPA and MBA with CPA Services for almost 25 years, one and only Mr. Ajay Kumar. Ajay, how are you?
I'm great.
Good to see you.
Oh, glad to be back. It's 4th season. We are looking forward to a wonderful season, and we have a lot of information with the new administration.
Yes.
Sanjeevji, we are expecting a lot of changes this year. So this is the year you want to stay tuned with this show.
Absolutely. You know, for us, it's like we're dragging ourselves into the tax season, but Ajay is all excited from January 2nd, 2025 to work on everyone's taxes, to help them out with all the information they really need to know, because taxes do get complicated and require a very, very professional advice and consultation. And Mr. Ajay Kumar and CPA Services can definitely help you out. I'd like to add one more thing. In case if you are in the middle of IRS tax audit, or if you have the tax audit matter pending since last year or 2, please take care of it right now. And if you're confused what to do contact CPA Services. You will see their number on the screen. All right, Ajay, as we begin our first episode for season 4, let's talk about the taxes that we're going to be filing. We're going to be filing 2024 taxes. So let's just go over 2024, a little bit of an overview of 2024 limits and everything. And then in the second half, we'll touch base upon 2025.
Absolutely, Sanjeevji. So let's start with the tax deadlines first. What are the tax deadlines? So remember, business tax deadline, LLC, S Corp files taxes 1 month sooner. So for LLC and S Corp, multi-member LLC and S Corp, the tax filing deadline is March 15th. For C Corp, personal taxes, single member LLC, the tax filing deadline is April 15th. You have an option to file the extension for 6 months. In that case, for LLC, multi-member LLC and S Corp, the tax deadline will be September 15th. And for C Corp and personal taxes, the tax deadline will be October 15th. Please remember, the extension is for filing the taxes, not for making the tax payment. So if you owe taxes and you are filing an extension, you are expected to make the tax payment along with the extension filing. Several states, including New Jersey, can deny your extension filing if you don't make proper estimated tax payments. Okay. So extension filing, remember the deadline.
Yes, that is the most important thing. All right, so now let's start with AGI, adjustable gross income. That is the first thing we're going to start with 2024 limits.
Absolutely. So now you have your W-2s. If you have businesses, you want to file your business taxes first, especially when they are flow-through businesses. Multi-member LLC, S corporation, so you know how much income you got from there. That income gets added to your W-2 income, interest income, dividend income, and the business income. To get to AGI, adjusted gross income is a function of total income, gross income, and then certain adjustments, certain expenses, including half of the self-employment taxes to reach to the AGI. After AGI, you have standard deduction, and then you get to the taxable income. And that's where the income tax brackets are calculated. Remember, the income tax bracket for the year 2024, for the taxes that we'll be filing now, it starts from 10% and goes up to 37% as far as the IRS is concerned.
Okay. All right. So after AGI, obviously non-cash contributions, and let's talk about qualified charitable contributions.
Absolutely. Let's talk about the charitable contributions here. So you can contribute to any charity. If you are doing the cash contribution, you can contribute up to 60% of your AGI. That's a lot of money. If you are doing non-cash contribution, it varies from 20% to 50% depending on the type of asset you are contributing. What if your income or the situation creates that you cannot use the full charitable contribution? What if you are contributing $1 million and your income is only 200,000? You have some stocks gain and you're giving it to charity. Remember, you have the right to carry forward. So this year you can deduct only up to 60%, but whatever the unused portion of your charitable contribution is, you can take it forward for next 5 years. So you don't really typically lose anything around it. But the limits are 60% of your AGI. If your AGI is 100,000, you can donate, give to charitable contribution up to $60,000 in this example.
Okay, is there a dollar limit that makes it easy for our viewers to understand?
There is typically not a dollar limit. It depends on the AGI.
Okay.
When it comes to the charitable
Just
contribution,
a 60% of AGI flat.
60% of the AGI is
Okay.
the typical formula for the cash contributions type of formula.
All right.
If you have non-cash deduction, then it depends from 20% to 50% when it comes to charities.
Okay. So now on a lighter note, let's begin with W-2s. Everyone should get W-2s latest by January 31st, 2025.
The W-2 should be mailed out by January 31st. So the system does not guarantee that the people will receive it as such, and that's why they have another 2 weeks till February 15th for mailing delays and everything. But all W-2s should be mailed out by January 31st.
Okay, 1099s who are
So
contractors.
1099s are meant for small businesses when you are making payments to contractors, consultant for ad hoc work, not the employees. Those 1099s should be issued latest by January 31st. So all 1099s should be issued to the proper social security number. You're not supposed to issue the 1099 on ITIN number. If your number starts with 9, it's not a social security number, it's an ITIN number, individual tax identification number. You're not legally authorized to work in this country. In that case, you should not be getting a W-2 and or a 1099. So just remember that, don't make that mistake.
Okay, very good, thank you. So now, talked about W-2s and 1099s. Now, last season, when we were just winding up after the tax season, and we used to give, basically you used to give advice and everything else. And I remember that we talked in a detail that if anybody wanted to invest money into any of the profit sharing plan or something to reduce their tax liability, obviously it had to be done before December 31st, but without waiting till the last minute, it would have been nice if it was done by December. Having said that, whatever is done, it's done. So now let's touch base upon the 401k limits for this year.
You're right. All the 401k contributions pass through the W-2. And since your W-2 is a picture that reflects your total pay till December 31st, all 401k contributions must be done prior to December 31st. But then there are certain retirement plans which you can contribute in up until late date. Let's say, for example, SEP, Simplified Employee Pension Plan, you can contribute up to March 15th. Talk about IRA, and this could be Roth IRA, traditional IRA, you can contribute till April 15th. So 401k is a plan where the contribution must happen before December 31st. And the last year's limit was about $23,000. In 2025, the limit is $23,500, assuming you are under 50. Then there's a catch-up contribution about $7,000. But 401k must be contributed as part of your employer W-2. You cannot choose to contribute yourself unless the employer, unless your the job is providing the 401k benefit.
All right. So 401k is done, IRA is done, catch-up contributions done.
Absolutely. And SCP, very, very common for small businesses. That's typically done before March 15th. Meaning there are certain retirement plans that you can still choose to do after the December 31st deadline.
All right. Now let's touch base upon another very important issue that many of our viewers really like to know, get more information on it: capital gains and capital loss.
Absolutely, especially at this time of the year, capital gains are hot. Some people made absurd amount of money into digital currency. That's capital gain. Some people sold a lot of assets and then now they are sitting on large amount of income. The typical question we are asked: how much taxes we have to pay on capital gain? So the capital gains can be of two types: long-term capital gain and short-term capital gain. Long-term means you held the asset for more than 1 year. You bought the asset, you sold the asset, and the difference between the buying date and the selling date is at least 1 year, more than 1 year. In that case, it's a long-term capital gain, and the long-term capital gain rates are 0% depending on how much income you have, 15% or 20%. The highest long-term capital gain tax rate is 20%. The short-term again meaning you bought the asset, flipped it. Fix and flip houses typically are short-term asset where you bought the property and sold the property within 1 year. The income tax rate are regular income tax rate, again 10% to 37%. So short-term 10% to 37% depending on how much income you have. Long-term 0% to 20%, again depending on how much income you have.
But it is advisable, if you can hold on to that capital gain for a long term, wait for 1 year, 12 months plus, right? It's advisable because you can
100%.
save substantial amount of taxes.
Especially if you don't have a need or if you don't substantially lose the value, it's always a good idea to pay half the taxes that what you have to.
Correct.
Imagine 37% versus 20%. Just remember, if you are not able to use all the capital losses, you have the right to carry forward them to the next year or the years in the future.
There you go,
Meaning
quickly.
the maximum capital loss that you can claim in this year or in any year is 3,000 plus the capital gain.
Okay, so 3,000, that's what I wanted
That's
to...
the maximum, right?
Yeah, exactly. I wanted you to quickly touch on that capital loss, 3,000 maximum, before we go into the break. With that note, we're going to take a short break. When we come back, we're going to look into 2025 limits for you to know when you file your taxes. Once again, this is the Tax Talk, Season 4, Episode number 1. Please stay with us. Welcome back to the second half of the Tax Talk with Ajay right here on ITV Gold. Folks, this is a Season 4. Familiar faces are back with you because of your popular demand. We are back. We're back here so that way we can get Ajay's advice and consultation and of course his knowledge that he shares with us when it comes to taxes, personal taxes, corporate taxes, and for any taxes matter, not only taxes but bookkeeping, payroll services, or even if you need virtual CEO, CFO, Science CPA services, a unique CPA firm in its own term here in the USA and especially for South Asian community can assist you with any tax matter. No question is a small question, no question is a silly question. Give them a call at 908-380-6876. We touched upon 2024 tax limits and AGI and capital losses and everything. Now let's get into some serious things. First, start with home office deductions because this deduction became very popular, very handy in the last couple of years, and people are working from home. So what are the home office deduction limits and the things to know?
Absolutely, Sanjeev. Yes, after the COVID year, home office expenses became extremely important that everybody is trying to use. Before I tell you what's deductible, let me tell you what's not deductible. If you have a W-2 job, your home office expenses, your travel expenses are not deductible expenses. You have to have a legitimate, formal business structure to claim the home office expenses. The good thing is you don't have to have profit in the business. You don't even have to have revenue. You don't even have to have sales in the business. As long as you have intent to make money, you have a formalized structure, LLC, S Corp, C Corp, whatever structure you have the right to claim home office expenses. A lot of times you can measure the area. This is my exclusive home office, 500 square feet. My whole house is 1500 square feet. So 33% is the home office. Or you can use the standardized method where you are allowed $5 per square feet up to 300 square feet. So home office expense is a great deduction that you should consider, especially if you have a small business.
Okay, and then good to know these limits. That means if you go to buy lunch or if you run some errands during your working hours while you take home office deduction in your tax return, it's not deductible, right? The
Well,
travel expense.
If you are buying lunch for a potential client, you can claim their share of the lunch as a business expense. But if you are buying lunch and or coffee for yourself, that's really not a business expense. So you have to be careful when you go into home office expense area, meals and entertainment area. That's what's kosher. And the rule of thumb is what expense you wouldn't have had if you did not have the business. Say, for example, if you had to pay the CPA to form the business. If you did not have the business, you did not have to pay the CPA. So that's a business expense. But you would have eaten anyway. You would have had the coffee anyway. So the expenses that you would have had anyway that are not dependent on this business are typically not the business expenses.
All right, now let's go into one of the very, very relevant topics for South Asian community, which is FBAR.
Absolutely. A lot of people, as you rightly said, we all come from a foreign country. If we did not come from a foreign country, our parents came from foreign country. So we are all immigrants in this country, and that's when FBAR and FATCA, foreign bank account reporting and foreign asset reporting, becomes extremely important. So in a nutshell, the rules are for FBAR, if you had more than $10,000 at any given point of time in all your bank accounts combined together, you have FBAR filing obligation. If you have FBAR filing obligation, you need to report all the bank accounts you had in a foreign country and the maximum amount you had in that account. Take an example quickly. Let's say you are buying a property in India. You transferred some money from US to India. For one day, the money stayed in your account, $100,000. And then this money went to the dealership. But for one day, you had $100,000. You have a couple of other accounts where you had $1,000, $2,000, $3,000. But just because for one day, at any point of time, just for one day, you had more than $10,000 in a foreign account, it triggered the FBAR filing requirement. Now, not only you have to report this account where you had $100,000, and we always report the maximum amount, you have to report all other accounts and the maximum amount that you had in those accounts at any point of time. That's FBAR in a nutshell. Looking at FATCA, where we say foreign asset reporting, this is more about if you have property. A lot of people have paternal properties or bought the houses or some shops in India, inherited some properties, land. You're supposed to report it if the property value is more than $50,000 at any point of time for a single filer or $100,000 for a married filing joint tax return. So if your property value, give or take, based on today's rate, is more than 85 lakh rupees at the end of the year, or about 150,000, about 1.25 crore rupees at any point of time during the year, for a married filing joint tax return, that's when the FATCA is triggered, and now you're supposed to report all the assets, even if you're not earning anything. It's not about the income tax. It's about asset reporting. So if you have a farmland, if you have a just open land, there is no rental income, but it's worth 2 crore rupees, you are still supposed to report it. That's FATCA for you.
That's about the rental income. But anyway, FBAR, FATCA, and the rental income we just covered. You know, folks, I just want to let you know that this is just the beginning of the tax season. So these numbers and all the details may confuse you or may put you into some kind of thinking mode, but that's where Science CPA service is for you. So give them a call at 908-380-6876. You will see the number on the screen, and they will help you with any tax matters.
I'll also remind Sanjeevji that we will have a separate show on FBAR and FATCA only. You can also go to our Science CPA Services YouTube video channel, and we have a show just on FBAR and FATCA only.
Yes, absolutely. You always give Ajay a lot of information on FBAR, so that's always helpful. Now let's look into the rental income, because folks made good amount of money in the last year, and then they invested buying a property and they rented it out. So now let's look into the rental income and expenses. How does that work?
Absolutely. So before I tell you the rental income and expense section, I want to remind everybody that rental income and expenses are taxable transactions even if they are outside this country. If you have a rental property in India, you should still report that property on your tax return in US. even if you are filing taxes in India, you should still report that property. The taxes that you paid in India can become an offset to the tax liability over here. But the key here is that you should report that transaction on the US tax return. So you have rental income, you may have some cleaning expenses, some tenant finding expenses, mortgage interest, property tax, travel, professional fees, depreciation is a big expense when it comes to rental properties. So after taking out all the expenses, you look at the net, and please, unless you are a realtor or unless you have a lot of properties and you're investing at least 1,000 hours into this business, into this rental business, rental property business is supposed to be passive business for you. Don't make that mistake. A lot of audits happen on rental income side because people tried to claim losses as an active losses. The losses from the rental property should be suspended and should be used in the year when you have rental profit or when you dispose of the property. A lot of people make this mistake when they try to claim the rental property as active business, and that's how they get audited.
All right. Okay. So with that note, passive activity rules, anything that you like to touch upon that?
Absolutely. So the main difference, I mean, you have to show that this is your main business. That's the active business means. So IRS has certain rules around it. If you have 1,000 hours into this type of business, and how do you have 1,000 hours? You could be a realtor, you could be a real estate professional, or you have 10 properties or a bunch of properties that you are managing and you don't have any other job. That's how you justify, this is my main business, this is my active business. But if you have a W-2, if you have other business and rental properties on the side, then it's hard to justify that you spent 1,000 hours on this business. So from that perspective, a lot of rental business by definition, by default, is considered as passive business.
Okay, very well. As we are closely approaching the show limit, the time limit, let's talk about quickly tax implications and inheritances.
Absolutely. So the key with the inheritance, and I want to differentiate when it comes to inheritance versus gifting. The question we are typically asked, my parents are old, can I have them gift the house to me? And the main difference when it comes to gifting versus inheritance. Inheritance means the property came to the next generation because the parents passed away. That's the inheritance. So when you gift something to somebody, their cost basis remains the same. Let's say if your father purchased the property for $100,000. Now the property value is $500,000. If the parents gift this property to their children, the children's cost basis will be 100,000. So if they sell it tomorrow for 500, they have to pay tax on 400,000. If the children gets this property through inheritance, their cost basis is the market value. Then you don't have to pay any capital gain taxes. So if you have an option, prefer inheritance over gifting. I mean, if you don't have an option, it is what it is. But inheritance, the key we want to explain here, brings the cost basis as the market value, not the purchased value.
All right. Now, I just want to make sure that these things, you know, the inheritance and taxes and everything else applies for the properties here in the USA also, not necessarily only properties in the country that you come from, right?
All of them.
All of
we
them.
don't differentiate where the property is located.
All right. Quickly, now let's touch base upon estate tax.
Absolutely. So estate tax is a function of estate. Estate is created when somebody passed away. Right now, the estate tax limit, meaning you don't pay any taxes up to $13.6 million. This is the limit for 2024. For 2025, the estate tax limit is 13.9. This is per person. For husband-wife, if you do the portability filing, Form 706 filing, you can combine the two limits together. So for all practical purpose, for $28 million of net worth can be passed to the next generation without worrying about the estate taxes. We are not saying estate planning is not important. What we are saying is estate planning is not for everybody. Unless you have certain assets, few $1 million at least, you don't have to worry about the estate planning as such.
All right, when you talk about estate tax, let's touch base upon gift tax exclusion.
Absolutely. So gift tax limit right now is $18,000, where you don't have to pay any taxes and you don't have to do any filing. So you can give $18,000 to as many people as you want without worrying about any filing. Forget about the taxes. The person who is receiving the gift, they don't pay any taxes. The person who is giving the gift, giftor, doesn't get any deduction, and none of them has to do any filing as long as the total gift for the whole year is under $18,000.
Very well. Folks, with that note, we come to an end of this season 4, episode number 1, Tax Talk with AJ. AJ, thank you so very
Absolutely.
much. And like I say, this gets a little complicated, or it's going to take a little time for you to get into your head, and of course, piece of paper and a pen and everything else. But do give Science CPA Services a call. They are the, with that sponsorship, the show comes in, the Tax Talk with AJ, right here on ITV Gold. You can reach Science CPA Services by dialing 908-380-6876 or visit sciencecpaservices.com. Throughout this season, every week, we're going to have more and more tax-related information. And mind you, it's personal and corporate taxes, all right? So they'll be coming, hoping that you will join us every week, same place, same time. AJ, thank you so very much.
Thank you, Sanjeevji.
Thank you, and I wish you all a very happy, best, and tax-free year ahead 2025. So long.
Thank you.